Hey everybody, welcome to our Condors, Calendars, and Butterflies webcast. My name is Brent Morris. Glad to be with you. We're here each Friday at this time, and we'll continue on with our series. We've started this kind of series of different strategies. We're going to do number 5 in the series today. And that's going to be kind of a special case on calendar spreads. Following up our discussion last week, which we did on calendar spreads, today we're going to be talking about earnings calendars, calendars on earnings, stocks that are having earnings. And so we'll get into that in just a minute. I'm joined by James Boyd in the chat, and appreciate James. And you can follow James or myself on X at Brent Morris CS, at James Boyd CS. Also, some familiar names there in the chat. People watching on recording, we're glad for you as well. And we're just glad you're watching. So now, before we get too far into this, though, let me just mention that options do carry a high level of risk and are not suitable for all investors. And the material is intended for general informational and educational purposes only. It's not an individual recommendation or personalized investment advice. Short options can be assigned up at any time up to expiration, regardless of the in-the-money amount. And the paper money software application is provided for educational purposes only. Now, one thing that the paper money software does is it gives you a good practice environment. One thing it does not do is it doesn't assign short options early. So just realize that is a difference between paper money and real money. And all investing involves risk, including the loss of principal. And there's no guarantee of an execution of a stop order that it's going to be at or near the stop price. Past performance is no guarantee of future results. There we go. Let's take a look at the markets here real quick as we get started. Markets are slightly in the green right now. You can see the S&P 500 chugging right along, but we've had big movers and little movers today. Let me give you an example. We had earnings yesterday on Amazon, last night on Amazon, and wow, up 10%. That's a lot of money, by the way. You know, this is a $3 trillion company. And so when it's up 10%, that's like a $300 billion, I'm rounding obviously, like a $300 billion move in market cap there. That's, and that can affect, I mean, obviously it's one of the biggies in the market. It can certainly affect the market. In fact, I would bet you that if Amazon weren't up today, the S&P 500, which is showing in the green, we just saw that, would probably be negative as a whole right now. That's how big an impact Amazon can have in the market. So that was a big earnings move. And there's other companies that moved a lot on earnings. That happens. You guys have seen that. Here's Reddit. Reddit's up about 10%. That was on earnings. What about Apple? Apple, of course, is probably more analogous to Amazon in terms of size. Apple's up just a smidge. So just because it has earnings doesn't mean it's going to move a lot. And that's one of the things when we talk about calendar spreads or any earnings trade is not, it's probably going to move some up or down, but is it going to move more or less than what the market expects? And that's the key. And when we talk about calendar spreads are more neutral type strategies. And what I'm about to say on calendars can apply to iron condors or just, normal butterflies as well. It probably doesn't really matter as much what the Greeks are doing. If the stock is moving a lot, it is going to affect your trade. You don't do calendar spreads if you think that the stock's going to go up a lot or down a lot or more than expected. Same thing with iron condors and butterflies. That's the key. Also, no matter what, we're going to be talking about implied volatility a fair amount today, because that impacts calendar spreads, and it impacts specifically the trades we're going to talk about. But it doesn't really matter. Well, the implied volatility impacts are probably going to be pretty minimal compared to what the impacts would be if the stock just moves a lot. You know, if I'm playing tennis and I have like superior equipment, that's great. If I'm playing Carlos Alcaraz, I'm going to lose anyway. It doesn't matter. It's a small impact as compared to my ability compared to a very good player. The implied volatilities moves that we talk about probably are going to be a smaller impact than the stock. But can it make a difference? Yes, it can make a difference, and that's the purpose of this trade here. There's kind of two main things we're going to be looking at. We're going to be looking at, number one, is a stock likely not going to take a massive move on earnings, bigger than expected move on earnings, and two, can we get the implied volatility to help us out on that? So that's what we're going after today. So let's take a look. I'm going to look at one, and by the way, if you just go to MarketWatch, by the way, here's the heat map for today. You see Amazon kind of sticking out. But if you go to calendar, you know, you can see, let's see, this is this week. Here's next week. You know, earnings is lightening up a little bit next week, but we get some bigger names next week. Look, there's McDonald's, right? Qualcomm, Amgen, AMD. These are all bigger companies. And so if you're looking at trades, earnings trades, this is probably a decent place to look at it. Okay. Now I'm just looking at S&P 100 companies here because I put that as you can put your own watch list in there if you want. If you want to see just side to side, you know, oh, my companies in my watch list, when are earnings coming out? Pull up your watch list here and you can see it just kind of visually in front of you there. But let's look at, I'm going to start off with Pfizer. Okay, so let's pull up Pfizer. They have earnings coming up next week. I have on the 4th, so November 4th. And how much is it going to move? Well, I don't know. We can kind of make some guesstimates on a move in terms of what the market is pricing in on a move. If I look here and go to the first expiration past earnings, and I see that it's showing about 1.3 plus or minus. Okay, it's not telling me whether it's going up or down, but that's giving you the expected range. Okay, a standard deviation range, plus or minus 1.3. Now, sometimes you can look at this and you'll see something up here that says, it's kind of, I think in that area, that says MMM. And that's actually probably a better way to look at it because that actually goes to the earnings and not to the expiration after earnings, which is what we're looking at right here. What's kind of messing it up, and the reason this MMM is not showing, the market maker move is not showing, is if your IVs are high enough here, if your IVs are higher here than on that, then it's not going to, or excuse me, not as high there on that, then it's not going to show on the implied volatility there. Okay, so there you go. But that gives us an idea, about 1.3. Okay, we're just rounding, about 1.3. Well, let's look at that on the chart. Let's go here. Well, what's the stock? The stock's about, and again, I'm going to round a little bit. We're at 24.5. 24.5 plus 1.3 is going to be 25.8, and 25.5 minus 1.3 is about 23.2. Okay, 25.8. Where's 25.8? 25.8 is roughly here on the chart. Sorry, my crooked line there. 23, that's supposed to be 23.2. I know it doesn't look like it, is roughly here on the chart. And so ultimately you got to decide. We don't know what earnings is, but that's, you know what? That's investing. That's trading. We don't know what the market's going to do. If my expectation is the stock's going to go beyond what the expected earnings are, probably this isn't probably the trade that we're looking for. Okay. Now, we can do technical analysis. You can see, well, mostly we're kind of going sideways here. So not a strong trend. Okay, that's probably a good thing for more of a neutral trade. okay? We have identified some potential resistance levels. Do you see why I identified these levels? Well, we kind of bounced off it there, bounced off it there. That's why I have that there. We bounced up here, so I added another resistance level there. Same thing on the downside. You know, post possible support, possible support, possible support. Okay, so but the range here, it's actually within our first resistance. It's within our second support level. Seems reasonable. That's what I'm going for on this trade. So the first thing we're doing on a calendar spread is we want something that's going to be a little bit more neutral. Okay, so here's what we're going to do. What I'm going to do is I'm going to go to the trade tab and I'm going to take the first expiration post earnings. Earnings next week on the 4th. This first expiration isn't post earnings. This first expiration is a couple hours from now. So that's no good. But if we go to first expiration post earnings, that's this one. I'm going to look at this and you know, you can skew this a little bit more bullish or bearish, but I'm going to go pretty much at the money, 24.51. I'm going to go, really, I could do calls or puts here because we're kind of right there. And I'm going to sell that. I'm just going to click on it. I'm then, for our purposes today, I'm going to go to a couple weeks after that. I can go to a week after that. There's not a, I'm just for our purposes in this class, I can go to a couple weeks after that. And I'm going to buy that contract. So I'm going to click on that. There's my calendar spread. Okay. That's a calendar spread on earnings. Now, let's do this. Let me actually go here. I'm going to analyze this trade. Analyze trade. We're going to go here and we're going to say, well, we said up 1.3 or down 1.3. We can kind of look at that on this graph too, right? And the current price is about 24.5. Up 1.3 is about 25.8, kind of in here. Down 1.3 is down to about 23.2, somewhere in here. That's well within kind of our tint area of where things are, where our break-even points are. So in fact, let me just throw on, let me just make sure, 1031, that's today, past earnings, going to break-even points. I think those are, so that fits the bill, so to speak, okay? So yeah, so Janelle said in the chat, and I appreciate Janelle, she's always very helpful in the chats with questions and comments and whatnot. And you, the rest of you as well, we appreciate your questions and comments. But didn't realize you can analyze a trade. Yeah, you can, when you're using the Analyze tab, and I don't want to spend too much time on this, you can go and you can add simulated trades from this menu, or you can look at trades here over there. Now, this is an options trade here, and this is used for options primarily here on this. You could look at it. Most of the functionality is meant for options, though, not stocks. We'll put it that way. Okay. One thing I want you to look out though here on this trade is this. Look at the purple line. Okay, so blue line, I'll kind of put some dots on it so you can see. Blue line represents that expiration. This is what a calendar spread looks like, right? It peaks out, kind of this tint thing, and you want the stock to be kind of this middle area where the strike is. That's where our strikes are. Okay. All right. But what's the purple line? Well, the purple line is, assuming we're on today's date, is what it looks like today. So in other words, obviously, if we enter the trade right now, we're not at this huge gain. That's at expiration, if it were to stay there at expiration. But this is where it is today. And what I want you to do is this. I want you to look at we're going to look at the purple line here in one sec, but what we're going to do is we're going to adjust implied volatilities on the trade here. Why would we adjust implied volatilities on the trade? Here's why. Because when we look at this and we look at our two contracts, here's the one that expires in a week. Average implied volatilities around 46%. Implied volatilities on that specific contract about 53%. Let's go out a couple weeks. Implied volatilities on this contract about 37%. In other words, there's about a 16% difference in our implied volatilities. Okay, 16% difference. Now, are these going to be totally equal after earnings? No, not necessarily, but let me just give you an example. We had earnings on PayPal the other day, okay? So I found a stock that didn't just come out with earnings last night, because implied volatilities often will take a day or two to settle down. But here's what I want to do. Let's look at PayPal. We had earnings a few days ago on this. And what I want you to do is look at the implied volatilities. By the way, you see these implied volatilities on option contracts that are going to expire in an hour or a couple hours. They kind of get wacky, okay, very high. So we're going to ignore those. But look at the levels of implied volatilities going forward. Do you see that? They're not that different. Maybe 1% or 2% from one another. Okay? Maybe 1% or 2% from one another, but they more or less equalize. So when we start looking at Pfizer, and we say, well, maybe these will equalize a little bit more, and we look at, let's see, this contract and this contract, and we said there's 53 implied volatility to 37 implied volatility. That's about a 16-point difference between those two. Well, let's say they equalize, and not totally equalize, but they're only a couple percent apart. So what I'm going to do here on this Analyze tab is I'm going to just drop the front month by implied volatilities by, we said 16%. I'm going to say down 14%. And when I do so, what I want you to look at is this. Look at that purple line when I press enter here. Do you see what happened to the purple line? That is showing, that's purely the impact of implied volatility, what we call an implied volatility crush. The front month implied volatilities, I can't make any guarantees, but they typically drop significantly. Later month implied volatilities don't drop so much. They tend to equalize. And so this is what happened. Okay? Now, is this trade going to work out well if the stock goes up to 27 or 28 or down to 22 or 21? Probably not. No, it's not. But if it cooperates in terms of where we think the stock's going to go, and of course we don't know, and we get the added benefit of that implied volatility, then it helps out our trade. That's why, even though calendar spreads, which we're typically going to say are Vega positive trades, in other words, we look for stocks where we think implied volatility is going to go up. In this specific circumstance where we see implied volatility dropping, calendar spreads could still be appropriate. So this is a special use case, so to speak, on calendar spreads. All right? Okay, so there we go. So let me hit up questions here on the chat. So JDLMI said, do we use the IV from your custom script yesterday? Okay, I'm not using that particular IV there for our purposes, although that is probably a good way to find stocks that have higher than normal IVs. But I don't want to complicate the webcast today with that. So you can use that, But when we're figuring out like IV drops and stuff, probably not that particular script there. Okay. So another question from Jim. Okay. Another question from Jim. Jim said, is there a rule of thumb as to how much IV should be? I don't care so much what the IV is, but what I'm looking for is the difference in the implied volatilities between the contract that we're selling here and the other contract. So if I see a 10-point difference, that's great. But let me give you another example here, per your question, of I was looking at a possibility on McDonald's, because McDonald's is coming out with earnings next week, at the IV differences, and just looking at the average IVs here on McDonald's. Again, we're going to ignore the one that expires today. Do you see, if I go out from this week to 2 weeks out, 32% to 26%, that's a 6-point difference there. That's a little bit on the thin side there, a little bit, not quite as much as I'd like to see in terms of the difference. So I don't care so much about the absolute IV, but in this particular circumstance, I'm looking at for the difference of those. And in general, I'm looking for something probably close to 10%. It could maybe be a little less than that, or greater. Okay, so just kind of rule of thumb there on this. All right, let's move forward here. So let's go back to that trade we were looking at. So we're looking at Pfizer, so PFE. Go back there. We'll look at our trade right here. Forecast, kind of not a bigger than expected earnings move. Implied volatility should help us out on this. And how much are we risking on this? Well, calendar spreads, you're risking the debit. So we're not risking much on this for one contract. So we may do more than one contract on this. And, you know, don't, oh, well, you're only risking $16 for a contract. Well, we're also not going to gain that much either on this, right? If things go well. I mean, the max gain on this, if we hit this perfectly, is up, you know, just $50 or just a little bit more. So let's go, and I'm going to click confirm and send, and we can look, and you can see it actually doesn't. Sometimes if you're wondering, you can look at like max gain, max loss. And remember, when I say max gain, max loss, I'm assuming we're getting out before the expiration of our front month here. But what I'm going to do is I'm going to up our number of contracts a little bit here. Okay, we'll do that. We'll do 4 contracts here on this. Well, in terms of position sizing, think about your risk on this. And typically what we're going to do on risk, and we'll, you know, there's no exact measure here, but maybe we'll look at 1 to 2% risk on your active trading portfolio. Okay. So when I say active trading portfolio, I mean, your entire net worth may not be in your active trading portfolio. Maybe you have a 401k that you're holding longer term or something like that. That's not what we're talking about here. We're talking about your active trading portfolio, and so your risk may make up that percentage of that. So it's the risk of that, and of course I'd multiply that by the number of contracts there on that. Okay. All right. So here we go. Now, let's confirm and send and talk about exits on this. Let me go to, this is going to be calendars. Okay. And, you know, sometimes you may want to put a note on here, and we're going to say earnings calendar or something like that. Okay. So we're going to click send on that, and there we go. Okay. So, so let's go and let's move forward, and let's talk about exits on it first of all. Okay. So exits. Well, last week we talked about exits. And one of the things we mentioned last week, we talked about rolling. And in fact, so last week we did this calendar spreads webcast in this webcast. Okay. And if you're interested, those were kind of plain old vanilla calendars, so to speak, our normal calendars. So here's a link. I just put it in the chat. If you're not watching live on the chat and you want that, you can just go to the playlist for calendars, for condors, calendars, and butterflies. And it was number three in the series, I think. Okay. You'll see it. It's labeled. It's clearly labeled calendars. Okay. So those are kind of the plain old vanilla calendars last week. This week is more the specialized case. But one thing we were talking about as we did this was we talked about exiting. There's times where we exit and maybe we roll. In fact, we rolled that in our managing options portfolio webcast on Wednesday. We rolled one of the trades we put in last week in this class on Wednesday. And so when do we roll? When do we close? You can rolling isn't anything special. You're just exiting the trade and entering a new one that looks pretty similar with a slight tweak to the original trade. Okay, that's essentially what rolling is. So when would you roll it? You roll calendars typically when you look at it and go, hey, this looks like a reasonable trade for a new calendar spread. Okay, so for example, if we're looking at kind of a more of a neutral stock and we think, oh, this is turning bullish on us, I'm probably not going to roll the calendar, at least not to another calendar. I may roll it to something different. But if I say, hey, this still looks like a good calendar spread, but I've made most of what I can make on the short contract, or it's just kind of going neutral and my time's going to expire or something like that, then maybe I roll it out to a new calendar spread. Fair enough. Okay. Because this is specific to earnings, though, we're probably not looking as likely to roll this because we're specifically targeting this and the implied volatility drop on earnings. We'll look to get out after earnings. Maybe not the day after earnings, maybe a couple days after earnings, after the implied volatility settle out of the short contracts. Okay, that's the goal. We want those implied volatilities to settle out. Now, so that's when we're usually going to get out of these, and these are probably less likely to roll. If we were to do this and maybe have more time, in this case, our long contract was only 21 days, and if there's only 14 days to go, it's probably less likely we're going to roll it. But if you just say, hey, this looks like a normal good calendar spread and I'm planning on being neutral, then you can roll it. But in general, when we're getting out, we're going to get out if we're about a week to go to expiration on calendar spreads, or for this contract, we'll say if it's after earnings, a couple days after earnings, we'll look to get out. If it turns directional, or because remember, this is a neutral trade, if it turns directional, if it breaks support or resistance, or kind of go hand in hand with the turning directional thing on that. And if we've made, 80% of what we can make or something like that, we'll look to get out on this. But this is a shorter term trade, so we're not going to wait. The impacts are going to be bigger because of the shortness of the trade, short-termness of the trade. Okay, I'm hoping that's making sense. So those are exits. Now you can automate the exit if you want. You can go to your trade and go to, let me just open this up here, and go to Advisor, and I can right click on this and I can create a closing order, and I could say, if this trade breaks out above, what we said this was a resistance, we'll give it a little wiggle room, 26.5. We said this was a support, 23, wiggle room, 26.5 and 22.5. We can just do that and get out at that point. Okay. So if I wanted to do that, I would just do here. This is a closing order on this. I can left click on the gear and say, look, I just want to get out. This is going to be a market order. Goods are canceled. And I'm going to get out less than or equal to 22.5. 5 greater than or equal to 26.5. Okay, there we go. And then you have an exit order on that, confirm and send, and send. There we go. Okay. Now, what if, so when you're trying to find these, you may intentionally target calendars or earnings. We looked at the challenge with not enough separation between our implied volatilities. We talked about that in the case of McDonald's. Another thing that may kind of disrupt your idea of doing the trade is if you're very strongly directional on this. Like I was looking at AMD. AMD comes out with earnings next week sometime, same day, November 4th. But, of course, technical analysis can change, technicals can change, trends can change with earnings especially, but if something's a strongly trending, a lot of traders of non-directional strategies, such as calendars and iron condors and butterflies, are less likely to do the trade. So therefore, we're going to skip AMD on that trade. Okay, I'm not going to do that on there. Let's look at another one though that maybe more fits the parameters. Here's Uber. Okay, not super strongly trending, I would say. We have earnings coming up on is it the same day? The 4th, yeah, same day. So we've got our Uber earnings coming out. Let's look at those IVs. So here we go. I'm not going to be looking at this one. I'm going to be looking at this one because this is the one that expires. This is the first expiration after earnings. And I'd encourage each of you to practice trade. That's why you have paper money. Practice the trade. And then what I want to do is I want to look at that difference between our IVs. I'm going to go out, again, I'm going to just kind of use 2-week difference here, a 2-week difference here on this. That's just kind of, you can go 1 week, you can go longer. It's going to cost you more if your long contract goes out further in time. You're going to have more risk and it's going to cost you more on that. And since this probably will fit the bill for their purposes today. Janelle says this would be 0 DTE. Yeah, this is 0 DTA. In fact, this is like 0 hours to expiration almost. We're coming right on expiration on that here. Again, that's why sometimes you'll see that IV being kind of extra high. In this case, it's not there on this one, but there you go on that. Okay, so I'm looking for the difference here. And in this case, it's about a 15 percentage point difference. But what I'm going to do is I'm also going to look at the individual contract. Well, where's our stock? Our stock's at 96.66. Do I have any bias on this? If I'm truly neutral, then what I'm going to do is I'm going to pick the strike that is closest to 96.66. If I'm a little bit more bearish or bullish, then I can skew those strikes a little bit. Here, I'm going to call this down here around 92 a support level. I'm going to call this up here kind of a resistance level. Let's see what the market maker move or what the expected move we can generate out of this is. We can kind of see on this. So let's see what we got here. We've got about a $7 move here on this. So not quite as ideal as the last one, which we kind of had some protection, if you will, in the idea that it's not true protection, but the idea that the move was less than where our resistance is. Here, if we have a $7 move and our stock is at, well, we'll call it 96.5, that's going to be 103.5, or $7 less 96.5 is going to be 89.5. So this is what the market expectations are. A move up to roughly there, a move down to roughly there. Now, if I think it's going to move more than that, probably not the right trade for you. If you think, look, it's more than likely going to stay within our bounds, then the trade may make sense there for us. Let's go back. Let's go to Uber. I'm going to go first date past expiration. Oh, was I a little bit more bullish or more bearish? I'm going to say, I'm going to go kind of, it seems like this is a little bit, if we were to draw a channel here, I guess is what I'm trying to say. This is a little bit more towards the middle, down closer to the 96 level or 95 level. That may be the strike I'm going to look at. We don't have strikes every 50 cents on this one. I'm stuck to every dollar on this one. So I'm going to go down and I can go 96. That's fine. It becomes a little more problematic if they come out in every $2.50 or something like that. Then you really kind of got to choose. Here I can go a little bit bearish, 96, or a little bit more bearish, 95. I'm going to go and, oh, by the way, you got to make sure the strikes you have available strikes for both. And here we both have 96 on both. Sometimes if you're looking at weekly contracts and monthly contracts, you don't have the same strike intervals and stuff. So it kind of messes things up. But in this case, I'm going a little bit. So I'm going to do puts because I'm selling this short put here. If I were doing the 97 strike, I'd probably do the call. Why? I'm trying to keep my short options out of the money. The theory is if you keep them out of the money, number one, very often you get tighter bid-ask spreads out of the money. Number two, there's less likelihood of early assignment. Odds of early assignment are always there. They're always present. But it's a little less if they're out of the money. So that's why I'm doing puts if the stock price is above the strike price we're looking at. And I'm doing calls if the stock price is below the strike price we're currently looking at. Okay, so here's what I'm going to do. I'm going to sell this 96. I'm going to go out. I'm going to buy the 96. Hold down my control key. Now, one thing I would just point out, if instead of 21 days, I went to 28 days, notice the difference in price here. Instead of 435, it'd be 460 there. Not huge. You can certainly do that. Little wider bid-ask spread, little more expensive, but you can certainly do that. Okay, so here's the trade. Should we click on let's analyze it. Let's right-click, click on Analyze Trade. This is what it looks like. Remember, we said that market maker move was up. I don't remember. It was up in the 103 level, and it was just below 90, 89.5 level or something like that. That's kind of the expectation is on that. That's today's date. That's expiration. That's the same as what we were looking at before. And what kind of implied volatility effects would we have? Well, let's see. Let's look. Okay, implied volatility column. You can add that if you don't have it. Just go up here. You can click implied volatility. Probability out of the money delta is one of your preset choices, I think. I've implied volatility, 66% on this one. Implied volatility, 49% on this one. We're probably not going to get a full 16-point equaling of those, but maybe we get a 13-point equaling of those or a 12-point. Let's be conservative and say they get within 4% of each other. So, we can do it that way. And Daniel pointed out, hey, look, you may get a bigger IV drop if you go out further. That's absolutely true. So let's see. 49% and 46%. So yeah, that is a benefit there, Daniel brings up in the chat. Good point there, Daniel. So we were saying what, 16% different? We're saying about, let's equalize them to about a 13% difference. Take a look at the purple line. Here's what I'm going to do. One sec. Let me move this up just a little bit so I get a little more room here. And I'm going to go to my IV, and I'm just going to adjust this one by 13%. Excuse me, I'm going to adjust this one by 13%, down 13%. Okay. Now, is this one likely to drop a little bit? Yeah, but this one's likely to drop more than 16%. We're trying to keep the spread here, so I'm going to say 13%. Look at that purple line. Do you see that? That's the difference that implied volatilities make. At the risk of repetition, the IV difference isn't going to make it do us any good if the stock goes up to 110 or down to 80 or something like that. But it can be a tailwind on our trade there if we have that. So there we go. So let's place a trade. Let me go back to my trade tab, and let me I'm going to click on confirm and send. So again, it doesn't give us a max loss, but on the a debit calendar, our max loss is 90 is the debit in this case. So I'm going to do a couple contracts here on this one, and we're going to confirm and send. We'll put this in our calendar bucket, and I'm going to write in here earnings, calendar, click on send, and there we go. Okay, so that's the trade. Now, have either of these filled at this point? They haven't filled, okay? So zero quantity. Oh, I take it back. Yeah, that Pfizer filled. Uber, sorry, let me get rid of this thing down here. Uber has not filled. So we can go back and tweak it if we want to get it filled. If we want to push a fill, we can go to our orders. There's Uber. I can right click, cancel replace, and say, yeah, it's right at the mid price. Probably not going to get a fill right at the mid price. Let's move that up a little bit. Confirm and send that. And there we go. Now we got filled on that. Okay. All right, everybody. Thank you very much. Now, let me just mention a few things. We're continuing this series here. We did calendars this week, calendars last week. We did earnings calendars this week. Before that, we did sessions on iron condors. I just put a link to the playlist for this class in the chat. That's for the whole, you can see all of them. Next week, we're going to hit a different topic, different type of trade. Hopefully we all learn together on this. And you can also, if you're watching on a recording, just go to the playlist on the Trader Talks channel. Key is you subscribe to that Trader Talks channel there. And a reminder to everybody, I think I saw a survey link. Did I see a survey link earlier? Yes, there was a survey link earlier here. So let me just, I'm just going to throw that in the chat there one more time for you, everybody. We appreciate your feedback, okay? We do appreciate your feedback. James, thank you for helping out in the chat. And everybody, coming up next, we've got market and sector analysis. Otherwise, have a wonderful weekend, and we'll see you all same time next week. Bye-bye, everybody.